Right, I think we can safely start. So good morning, good afternoon, good evening, everyone. This is an IA webinar on ISAP 7. So the next slide. For those who don't know me, I'm Nick Dexter. I was chair of the ISAP 7 task force. I'll be moderating the webinar today, and I am joined by, on the next slide, please, Toshihiro Kawano and Ralph Blanchard, who are both members of the ISAP 7 task force. Next slide. So just a few housekeeping items. We've got an hour and a half scheduled for this webinar, so we've got plenty of time for questions and comments. Verbal capabilities have been turned off, but you can submit your questions or comments by clicking on the Q&A icon at the bottom of the screen. We will answer questions during the Q&A session at the end of the panel discussion, and we should have plenty of time for Q&A at the end. A YouTube recording of this webinar will be made available on the IA website within the next day or so. Next slide. So as I say, we are all members of the Actuarial Standard Committee's ISAP 7 task force, but today's remarks are our personal opinions. They are not and should not be construed as official positions of the IAA or the ASC. Thank you. Next slide. So today's agenda. So we're broadly going to just go through, there's a bit of background on the Insurance Capital Standard, the ICS, to kick off, and then we'll sort of talk through the different sections of the ICS, trying to explain along the way a bit of background where appropriate on some of those sections rather, and then we'll have the Q&A session at the end. Next slide. So the members of the task force were Adrian Allett from New Zealand, Ralph from the USA, me from the UK, Toshihiro from Japan, Greg Martin from Australia, Margaret Tiller Sherwood from the US. So we got a good selection of views in there. Next slide, please. So now moving on to the Insurance Capital Standard, the ICS itself. So as many of you will know, the ICS is a component of ConFrame, which consists of both quantitative and qualitative supervisory requirements as published by the IAIS, which is tailored to the complexity and international scope of internationally active insurance groups, the IAIGs. The purpose of the ICS is to create a common language for supervision discussions on group solvency, and the aim is to enhance global convergence among group capital standards. Currently, we're working with ICS version 2 during the so-called monitoring period, and I'll come back to the monitoring period in a moment. Monitoring period ends next year, when the final version of ICS is expected to be published. So because we didn't want to wait until the end of the monitoring period and the finalized ICS to work on this ISAP, we based this standard on the version 2 rather than waiting. Now, the background to this, since 2013, the IAS have been undertaking a multi-year quantitative field testing process with volunteer insurance groups, including IAIGs. Now, as many of you will know, the results of the field testing have not been made public. So individual actuaries working for field testing firms have their own group's experience, but there isn't currently wider practical experience within the profession of ICS. Consequently, on the task force, we've relied on a thorough reading of the ICS guidance, although we have input from a few members who have had that practical experience. So as I said, it was agreed that implementation of ICS version 2 will be conducted in 2 phases. Firstly, we have this 5-year monitoring period from 2020 to 2024. And during this time, ICS version 2 is used for confidential reporting to the group-wide supervisor and is discussed in supervisory colleges. During the monitoring period, the ICS results will not be used as a basis for triggering supervisory action. But at the end of the period, the implementation of the ICS will be as a group-wide prescribed capital requirement, or PCR, which is a solvency control level above which the supervisor does not intervene on capital adequacy grounds. Now, there are 2 aspects of ICS, which is worth mentioning, which actually weren't included in ICS version 2, which may appear in the final version, and that's the gap plus approach and internal models. So rather than base ICS on a separate market adjusted valuation, it might be possible to use an adjusted gap valuation approach. And they're currently working on the aggregation method, which is a capital measurement standard being developed in the US, which should provide comparable outcomes to the ICS in contrast to the Now, if the aggregation method is deemed outcome equivalent, it could be used in place of the ICS in the US and elsewhere, including as a prescribed capital requirement for IOGs. Moving on to internal models, in the candidate ICS as a PCR, internal models could be recognized as another method for the calculation of the ICS capital requirement. Use of internal models will be subject to requirements related to the development, use, and maintenance of the model. So it still remains to be seen how that might be developed in practice. Next slide, please. So now moving on to the ISAP 7 itself. The IAA intends this ISAP to facilitate convergence in standards of actuarial practice in connection with the ICS. It's there to increase public confidence in actuarial services provided in connection with the ICS and to demonstrate the IAA's commitment to support the work of the IAIS in achieving high quality comparable capital standards. The ISAP aims to provide guidance to actuaries when performing actuarial services in connection with the ICS. And in particular, it's intended to increase users' confidence that the actuarial services have been carried out professionally and with due care, consistent with the ICS, that the results are relevant to users' needs, are presented clearly and understandably, and are complete. And finally, that the assumptions and methodology are disclosed appropriately. Next slide. So what is the scope of this ISAP? It's always a challenge in developing an ISAP to know what the scope is. But essentially, this ISAP addresses the fact that the ICS will usually be based on a company's published valuation, but these will need to be adapted to the ICS current estimate basis, and that there will be elements of the ICS that require actuaries to use professional judgment. Next slide. Now, many aspects of the work in relation to the ICS are already covered in ISAP 1. So ISAP 1 is a prerequisite for compliance with this ISAP, and we haven't sought to replicate anything in ISAP 1, although there are quite a few references to ISAP 1. Sorts of things that are in ISAP 1 which are very relevant here are the reliance on the work of others, data quality, and model governance, to name but a few areas. Now, one of the challenges around this is that ICS, as we say here, there is an enormous amount of guidance and support to the ICS calculation. It's over 200 pages long for anybody who's looked at it. And the intention is not to replicate that guidance in this ISAP. We did receive some comments in the consultation when we put this out to FMAs, asking us to give more guidance in some areas. And it was felt sometimes that the draft ISAP 7 provided rather generic advice concerning actuarial practice, and even that it provided limited actual value-added guidance for actuaries performing ICS work. Some FMAs wanted more detail on specific aspects, such as the determination of discount rates, the adjustments to the top, middle, and general buckets, etc. And we as a group looked carefully at the ICS guidance, and we have only included material in the ISAP where we felt the extensive ICS guidance was not sufficiently detailed. Now, the ISAP uses various terms whose specific meanings are defined in the glossary. These terms are highlighted in the text of ISAP 7 with a dashed underscore and in blue, which is a hyperlink to the definition. This ISAP also uses terms defined in the IAS glossary or used in the ICS, in which case they have the same meaning. The items that are highlighted in the text with a double underscore in orange colour are included. Next slide. Now, one term that caused us a lot of discussion was the term financial statements. And in fact, within the ICS guidance, there are various terms. It's not used consistently, but essentially, it's pretty clear that it all means the same thing, even if the terms aren't consistent. So we in the ISAP refer to financial statements, and this is consistent with the instructions for the ICS calculations, which actually do not define the term, but describe it as the starting point for determining the ICS balance sheet. The instructions require ICS filers to make adjustments in certain situations to their audited consolidated balance sheets. Many of these adjustments are likely to require assistance from actuaries, which is why we've included them here. This ISAP also refers to the content of the ICS. If the ICS is subsequently amended, restated, revoked, or replaced, the actuary should consider the extent to which guidance in the ISAP is still applicable and appropriate. And we will be clearly looking at revising this ISAP once the finalised ICS is published. Over to you, Toshihiro.
Thank you, Nick. Next slide is Section 2, Appropriate Practices, 2.1, Relevant Knowledge Requirement. Sufficient knowledge and understanding of information are required to perform the assignment. The ICS, in particular, the requirement in relation to current estimates. How those current estimates will be used to determine the capital requirements. Any local regulatory requirements relating to the ICS, a business environment in which a group operates, a group's products and operations, the methodologies and assumptions used by the group, and the rationale to help identify modifications needed to comply with the ICS guidance. How law affects the application of the ICS. Next slide, please. 2.2 Materiality. The actuary should understand the distinction between materiality with respect to the actuarial services and to the preparation of an ICS submission. 2.3 Proportionality. The degree of refinement in specific assumptions or methods recommended by the actuary should be proportionate to their possible impact on the results of the actuarial services. Next slide, please. 2.4 Contract recognition, contract boundaries, and time horizon. The ICS defines its contract recognition and derecognition, contract boundaries, and time horizon. So, actuaries should consider whether these treatments under the ICS are different from those adopted under the financial statements. The current estimates reported in the ICS and/or the underlying assumptions may need to be adjusted from the insurance liabilities reported under the group's financial statements. Also, the actuaries should disclose the work undertaken to identify what adjustment may or may not need to be made and the impact of the adjustments. Next slide, please. From this slide refers to the 2.5 methodology. 2.5.1 current estimate. The actuary should consider whether the current estimate used for the ICS submission should be adjusted from the insurance liabilities in the financial statements. The actuary should disclose the work undertaken to identify what adjustments may or may not need to be made and the impact of the adjustment. So the modification adjustment to the current estimate is one of the essential part of the ICS submission. 2.5.1 Management action. Management actions for participating adjustable products. In the ICS, the current estimate calculation for participating adjustable products may recognize management actions when such actions are objective, realistic, and verifiable. When determining current estimate for participating or adjustable product, the actuary should consider the following. 1. Objective. The circumstances should be clearly defined and documented and agreed by the relevant managing bodies. Next slide, please. 2. Realistic and verifiable. The management actions should be consistent with other assumptions and estimates within the ICS. Also be consistent with relevant policies approved by managing bodies and policyholders' reasonable expectations, not dependent on actions by third parties, and be reviewed in the light of actual management actions employed over time. Next slide, please. 2.5.1.2 Options and Guarantees. Where valuation options and guarantees for current estimate should be different from the insurance liabilities in the financial statements, they actually should consider valuation methodologies such as stochastic approach, which take into account the expected cash flows relating to options and guarantees. Next slide, please. 2.5.2 ICS capital requirement. This is the risk amount. 2.5.2.1 grouping for calculating the ICS values. For life, when deciding on the homogeneous risk groups for life insurance risks, we actually should consider whether the homogeneous risk groups are set narrowly enough so that the policies in each risk group reflect similar risk characteristics, but not so narrowly that the risk groups are not significant. For the next non-life part, I'd like to pass on to Ralph, please.
Okay. Thank you, Toshihiro. For the non-life side, there's a segmentation that's in the ICS that's generally, that varies by country or region and by line of business, and that's generally in line with what's required in that country or region. It generally follows what the regulatory reporting requirements are. However, that may differ from what's in the group's financial statements. So in trying to map what's in the group's financial statements to the segmentation in the ICS, the actuary should be aware and should consider the relationship between those two mappings. And just as an aside, much of the actual required capital on the non-life side is a factor-based approach. So again, you're not trying to do an estimate, but you're trying to basically do a mapping with some adjustments, such as for discounting if you're not currently discounting. Next slide, please. The ICS also allows for risk mitigation, and the basis of the ICS requirement is a 99.5% VAR for 1-year time horizon. So with a 1-year time horizon, you don't just care about risk mitigation and effect at the balance sheet. You also care about, risk mitigation that will be in existence for the full year. So you need to affect both the existing risk mitigation techniques and the renewal of those techniques for the coming year for those that expire, such as a CAT reinsurance program that may expire mid-year. So again, one example of a risk mitigation is catastrophe reinsurance. Toshihiro, do you have an example of a risk mitigation for life side?
Yes, thank you. I'd like to comment on hedging. Hedging is used to mitigate market risk exposures. Hedging is usually renewed every 3 months. In this case, the ICS requires that 25% factor is applied to the risk mitigation effect. However, ICS allows taking into account the renewal to recognize full effects for 1 year if the IAIG expects to renew. The requirements of an expectation to renew are specified in the ICS. One of the 7 requirements, for example, is that The renewal is consistent with previous business practice and documented strategy. Many requirements in there.
Yeah. So the
That's-
ISAPs, thank you, Toshihiro. The ISAP 7 requirements, required considerations include, again, this is consistent with the ICS technical specs, whether the structure and history of the mitigation impact is likely to remain relevant, and whether it's likely to be effective over the ICS time horizon under all reasonably foreseeable circumstances. That phrase, reasonably foreseeable circumstances, is a direct quote from the ISAP, and it's a very close paraphrase of what's actually in the technical specifications. Next slide, please. The ICS also requires reporting reinsurance recoverable cash flows by reinsurers' financial strength rating. Typical, in my experience, that's not always required in the financial statements. It may be embedded in what's reported in the financial statements, but in any event, the actuary should consider whether appropriate allocation processes are needed to meet this requirement of breaking out the recoverables by time period and by financial strength rating. Any material assumptions or judgments that result need to be should be communicated to the principal, and those processes should be reviewed for reasonableness. That includes both the allocation to the credit rating and the allocation to the payment year. Next slide, please. There's also a list in the ISAP of things that the actuary needs to be aware of for the impact, and one of those is cessions to reinsurance pools. A lot of non-life insurers cede to pools where the actual, the pool itself may not have a credit rating, and even if it does, that may not be really relevant to determine the default or collectability risk. So the actuary should be aware of as to whether there's a need to look through to the ratings of individual pool members. For example, a lot of residual market mechanisms have cessions to pools. A lot of major reinsurance contracts have cedes to pools. There also could be multiple credit ratings existing for a given reinsurer. The ones I'm familiar with are Moody's and S&P and Fitch, and there are others out there. The actuary should also be aware of whether there's any differences in the contract boundary and recognition criteria for the ICS versus the financial statements. This was alluded to earlier in something that Nick talked about. So next. So now I'd like to pass it back to Toshihiro.
Thank you, Rolf. The next slide is 2.7, assumption setting. 2.7.1, general considerations. You actually should consider whether the assumptions under the ICS should be different from those adopted under the financial statements. Where they are different, the relevant ICS assumptions should be treated as being subject to ISAP 1, paragraph 2.7 or paragraph 2.8. They actually should disclose changes in the assumptions and the impact of the changes. Next slide, please. 2.7.2, selecting assumptions. Policyholder behavior lapsation. Where the assumptions under ICS to calculate current estimate should be different from those adopted under the financial statement, we actually should consider criteria and factors such as the following. Likely behavior of policyholders, taking into account factors such as anti-selection and the effects of non-financial considerations. Characteristics of how the insurance contracts are sold and serviced. Significant scheduled changes in premiums, charges, benefits, or terms and conditions, and any short-term spikes in cancellation rates created by the exercise of certain options. Next slide, please. Future discretionary benefits. Discount rate used to calculate the present value of the cash flows that are consistent with the investment returns anticipated in the estimate of the future cash flows. Returns on assets which are estimated using prospective expectations consistent with current expectations of future economic conditions and associated impact on the estimates of future cash flows or cash flows which are subject to a floor or a cap. Next slide, please. Expenses. The group's cost accounting and expense allocation policies. The group's past experience and current business plans and treatment of non-recurring expenses. Non-recurring means the one-time expense and the terms of any outsourcing arrangements. Next slide, please. The inflation relationship between the inflation and investment assumptions and currency exchange. Current expectations of future currency exchange rates both should be considered. I'd like to hand over to Ralph from the next slide.
So next slide, please. Again, these are all dealing with considerations, and factors to consider when selecting assumptions. With regard to insurance risk, items to consider when selecting the assumptions includes the characteristics of the insurance contract sold. In addition, the characteristics of the policyholder and the way the contract was sold. That could be alluded to in terms of policyholder expectations. Also, whether the risks has changed because of pandemics or climate change impacts. Another characteristic to consider is past experience of the incurred claims and whether that past experience is relevant to expected future experience. In addition, possibly relevant. I'm hearing some background noise. Okay. In addition, one of the characteristics to consider is the practices of the group, such as particular underwriting practices that may affect the assumptions to be selected, or the actual claim management practices of the group that would affect those assumptions. Next slide, please. Earlier, Nick had talked about possible adjustments to the the financial statement balance sheet and producing the ICS balance sheet. Well, some of those may have tax effects. So where the actuary is involved in reviewing the tax, the tax impacts, the actuary should also be reviewing the deferred tax adjustments that may result from those ICS adjustments, ICS balance sheet adjustments. That doesn't mean there will be, but that there could be. And if they're warranted, there's a requirement in the ICS for those adjustments to be made. So if the actuary is reviewing that material, the actuary should review the deferred tax adjustments from the ICS adjustments. Next slide. With regard to non-life specific issues, there are two major ones. First of all, premium liabilities. A premium liability for many gaps, including US GAAP, is the unearned premium reserve. For IFRS 17, there's the liability for remaining coverage. Well, the ICS doesn't use either of those. The ICS requires the premium liability to be calculated under a market adjusted valuation approach, or MAV approach, or two different proxies could be used, which are based to kind of an unearned premium as the starting point. But in any event, if the MAV approach is used, a key area where there's difference of opinion is how you should treat general overhead expenses in the cash flow arising from a premium liability. Some include it, some don't. There's a whole range of possibilities. But where the MAV approach is used, the actuary's professional judgments in this area should be communicated to the principal. If instead one of the proxies is used, that should also be communicated to the principal. With regard to CAD estimates, which some label as PMLs, even though they're not technically PMLs, they're value at risk values. Again, the ICS is based on a 99.5% VAR for 1-year time horizon. So where the actuaries services include reviewing those CAD VAR estimates, the actuary should review those estimates for reasonability and consistency, including the consistency and comparability across perils and jurisdictions, because those estimates are required for a variety of listed perils and by region. But an estimate that may look reasonable in and of itself may not be consistent with work done for a different peril, for a different region. So the actuary, if involved in this, should be reviewing those. Next, I think I'm passing it back to Nick.
Yep, thanks, Ralph. So this last point stems actually from something in ISAP 1. ISAP 1 states that the actuary should consider and address the sensitivity of each methodology to the effect of variations in key assumptions when appropriate. In determining whether sensitivity is being properly addressed, the actuary should take into account the purpose of the actuarial services and whether the results of the sensitivity tests reflect a reasonable range of variation in the key assumptions consistent with that purpose. So we think that if we are in the context of ICS, we think it's important to consider the sources and degree of uncertainty in relation to the adjustments to the estimates in the financial statements and in the calculation of the values reported in the ICS submission in a similar way to as required under ISAP 1. Next slide, please. Now, the last section that we got here is on communication. And as we all know that in any of our work, it is really important that we appropriately communicate what work has been done. And within the previous sections of the ISAP 7, there are various points where we've explained what should be disclosed to the principal. And what we've done in this section is primarily drawn together all of those statements into one convenient section. So the first bit here is around the descriptions of the material changes and adjustments in the assumptions or methods from those used in the financial statements. Now, clearly, quite a lot of work will have already gone on in relation to the financial statements. So in making adjustments to those, it's appropriate that the changes and adjustments are appropriately discussed. In addition, we have said that there should be disclosed the rationale for and impact of any material changes to adjustments made to contract recognition, contract boundaries and time horizons, assumptions or professional judgments involved in the estimation or allocations for reinsurance as recoverable, the professional judgments included in estimates of premium liability, and the potential sources of uncertainty that we've just referred to. Next slide. In addition, information should be given on the professional judgments involved with grouping for the calculating the ICS values and risk mitigation, and any material uncertainties or limitations in the law and the approach taken to these in the context of the calculations of current estimates should be appropriately disclosed. So that gets us to the end of ISAP 7 itself. So if we go on to the next slide, we can now open this up for any questions for any of us.
Yeah, Nick, while we're waiting for questions, just again to elaborate more on the discounting, people who are filling out the ICS, they are given prescribed yield curves by currency for the December 31st valuation, and also I think for March 31st valuations. So there is no actuarial involvement with selecting the those yield curves. They are prescribed, just given to people, which is one reason why there's no real guidance in the ISAP for how to select the discount rate. You don't have a choice.
That's a good point. I mean, it's one of the things that I took from going through the ITS guidance. There are quite a few areas where there is an awful lot of guidance given that means that there is very little actuarial or no actuarial judgment required, because I say simply, but it's quite complex. But you follow the instructions that have been given rather than actually using actuarial judgment. Okay, so I have one question. What issues were subject to the highest degree of debate among the task force members on the inclusion or exclusion and wording in ISAP 7? That's a good question, and this is where we're going to stretch our memory of those discussions. Toshihiro, Ralph, what do you recall of those many debates that we had?
I saw the biggest debate being how to actually deal with, and Amalie would like to answer it. I saw the biggest issue being how to respond to people who wanted us to interpret the ICS material, or how to go beyond the ICS requirements. You know, how to deal with people who said, well, gee, this is generic, and we felt kind of hamstrung. So it seemed to be more of a debate between us and some of the commentators. I don't know, Amalie or Toshihiro or Nick.
Yeah, I think you're right. I do remember that you know, we had some areas where there are peculiarities in the application, or could be in individual territories, and we decided that's, you know, that this is a global thing, rather than giving it, for example, on UK participating contracts as an example, where there are idiosyncrasies that are applied to the UK, and also this thing that we've always had, that this is not a training exercise, so we're not aiming to train actuaries on how to use ICS. That's not the role of an actuarial standard. And in fact, the case that's going on at the moment is we're working on an ISAP to support the ISSB work, and we have actually split that into an IAN of the educational notes and the ISAP itself. Now, it may be at some point that we decide that an IAN is needed to support ICS work, but because ICS work is to a small number of firms, we've probably not got as far as the practical experience to develop in IAN. Toshihiro?
And from the international perspective, more detailed description on each of the capital requirement in each jurisdiction may contradict to the subsidiarity principle of the IAA. So we have limited our scope to the ICS.
We have another question.
How do you see the comparison to IFRS 17?
Okay, we have one before that.
Oh, sorry, I just skipped over one. You're right. Which current financial statements regime is likely to be the most different to the ICS requirements? Ooh, there's a challenge to answer that one.
Is that you have to look at the life versus the non-life. So, with the life first.
Yes, from the life side, some jurisdictions, the insurance liabilities are reported on the fixed basis. That means that the discount rates are fixed at the inception of the policies. So that is a most different part of the insurance liabilities reported under financial statements and the ICS requirements.
Well, by jurisdiction, though, it's not clear.
Sorry, Are you answering the rule I originally read out, the IFRS 17 question,
Oh,
Toshihiro?
no, it's the first question.
Okay.
The difference between the financial reports in the jurisdiction, like Japan, it is a more not
Right.
the floating basis, but cost fixed basis. So the discount rates should be different from the financial reporting and the ICS current estimates. And the next difference is the risk margin. Risk margin is sometimes implicitly included in the life table or the assumptions, but it's not different from the ICS requirements.
Yeah, and the non-life side, these are kind of related because the non-life side, despite the discussion that happened at the IASB, non-life financial reporting was largely consistent worldwide, with the only real major, for differences for insurance contracts being, do you discount and how do you handle the risk margin? So, for the claim liabilities or the liability for incurred claims, ICS prescribes a discount rate, so that's different from IFRS 17, and because it prescribes a discount rate, that's different from every other country. But it's not a hard adjustment to make, because if you're doing non-life claim liabilities, you're typically able to look at some kind of payment pattern estimate. Another issue with ICS is it prescribes the risk adjustment, which it calls the MOCHI, margin over current estimate. So that's a replacement, but that's not hard to adjust for. Other than that, for the underlying unpaid claim estimate on an undiscounted, pre-risk margin basis, it's pretty comparable worldwide from my experience. The biggest difference has been on the premium liability side of things, because what IFRS does, or what the ICS does, isn't consistent with any gap out there. It's probably closest to Solvency II. There was a lot of Solvency II in the final ICS, so it did want a MAV type of a calculation where you would reflect the present value of the cash flow runoff from the premium liability. But again, the big uncertainty there is the treatment of general expenses. And the feedback I've heard is that the numbers, there's a comparability issue across the groups with regard to how they treat that. So there's a risk of the ICS numbers not being comparable. But again, this is opinion, this is not an official statement on it. But in general, other than the premium liability, everything should be fairly consistent and straightforward after you adjust for a discount and after you adjust for taking out a risk margin and putting in a MOCHI in the ICS. That's the insurance, liability, and asset piece of things.
Right, thanks for that. So the next question was, how do you see this in comparison to IFRS 17? This is it's a good question, but I guess that this is a tricky one, given how new IFRS 17 is and how few people have actually done the ICS. So I don't know, Ralph, Toshihiro, you've seen anything on that?
Well, I had hoped to. I was addressing before the balance sheet items for income attribution, and there's really no calculation of income that I can remember in the ICS.
Yeah.
Yeah. Do we want to deal with the question from Jose?
Yeah. Yes. Probably. So this is an interesting one. So, although not directly related to the ISAP, could you please elaborate a little more about the risk aggregation work being done in the USA, and that you mentioned at the beginning of the presentation? Also, is the IAA involved? I'll kick up on this one, and then Ralph and Toshihiro, if you've got anything to add. So the IA isn't involved. I mean, it's one of the things that we in our regular discussions with the IAS, we do ask, is there anything that we can be doing to support your work in this area? And the IAS is quite clear that this is, confidential. They don't want to open this up to third parties, even the IAA. But we're welcome to comment when they have consultations come out. And there was a consultation on the aggregation work, I think in the middle of the year, which we did put some limited comments on. But it is quite difficult without having the detail that the IASs have to actually add anything meaningful to their work. So at the moment we're not. So Ralph, I don't know, are you close to any of this work on the aggregation method in the US?
I was intimately involved in this.
Right.
Both in the aggregation method and the US comparable version called the group capital calculation, of GCC, and to a lesser extent what the Federal Reserve looked for its building block approach. The interesting thing is the aggregation approach to coming up with group capital was first developed as one of the alternative things they looked at for Basel II. So, the idea started in the banking world, where rather than trying to come up with a consolidated approach, you actually look at what the legal entity requirements are that are most in line with where the supervisory authority is. So that's what the aggregation approach tries to do. It tries to actually look at jurisdiction by jurisdiction what the legal entity requirements are and totaling them all up, rather than creating something that on an aggregate basis that doesn't look at what the legal entity and jurisdictional requirements and authorities are. The IAIS, as part of its testing, has tried to look at whether you'd have comparable results for the aggregation method than you would for the ICS. And one of the issues is, what does comparable mean? I think they've tried focusing on whether you would have the same kind of supervisory action resulting from the results. They've also tried to look at the impact on various scenarios, so that each of those methods react the same way to various scenarios. And the underlying problem is for non-life, the focus was a lot of financial market scenarios, and the non-life side isn't as impacted by financial market scenarios, so that discussion really wasn't relevant. The other issue on the non-life side was that a scenario that means something to a company writing homeowners business in Japan isn't going to be very meaningful for a workers' comp writer in the US. One may care about earthquakes, the other one may not care at all about earthquakes. So that's been one of the issues, trying to come up with the comparability criteria. That's a brief thumbnail as to what the aggregation is doing and some of the issues related. And the other thing to keep in mind, again, this is my opinion, the process has a heavy layer of politics involved in it. And I won't go any further than that at this time.
Yeah. No, I think you're right. I think we will appreciate when you're talking about international things that's always going to be the case. Another question: is there a significant difference between ICS estimates and other reporting requirements with regard to ceded reinsurance in non-life? So I'm afraid, Ralph, that's another one for you.
Yeah, one of the quirks is that the ceded estimate in the balance sheet is going to include, for the ICS, present value. There won't be any risk adjustment, but there will be a present value there. So it has to be discounted. So you are going to be, for the ICS, if your current ceded estimates are undiscounted, you have to discount them for the ICS. If they include a risk adjustment, you have to remove the risk adjustment for the ICS. The biggest difference is you have to actually break it out by the timing of the flow, and you have to break it out by the credit rating. And then they also want to know if you have collateral associated with the seated balance. How does that relate to the timing and the credit rating? And the reality is that for non-life, a lot of your seated number is an IBNR calculation. It's an aggregate function, and you don't have it broken out by year, by contract, by payment period, by reinsurer, because you could have one scenario where you're ceding to one reinsurance treaty for liability from policies from 1 year, and another scenario where it's a different reinsurer in a different payment year. So it all gets kind of averaged in an IBNR calculation, but you have to do some kind of an allocation in detail, including for the any collateral you have. In my view, the technical requirement is problematic, can't be done. So some reasonable estimate considering materiality and proportionality is required. So to me, again, the significant difference is more in the allocation to those items than in the total balance.
Good, thanks, Ralph. Okay, I think that we've come to the end of the questions. So can we go to the next slide? So I think that all remains to say that in terms of, if you need any assistance or any questions regarding the adoption of implementing standards, then as usual, you should contact the IAA Secretariat. Namali's contact details are there, and we will get back to you with any assistance that we can give. So with that, I'd like to thank all of you for attending, and thanks to Ralph and Toshihiro for presenting the bulk of this presentation, and we look forward to seeing many of you in Lisbon. So we'll see you then. Thank you.